Welcome back, traders, to another video in the Mastering Stock Chart Analysis series. Today, we're going to be going over some basics of understanding supply and demand and how we can use it to make money while trading. So, first, as always, we're going to read over some things and then we're going to put it into perspective on a actual chart. So, first, we're going to learn what is the law of demand. So, the law of demand holds that demand for a product changes inversely to its price, all else being equal. In other words, the higher the price, the lower the level of demand. So that means as price rises, demand usually decreases. So because buyers have finite resources, their spending on a given product or commodity is limited as well. So higher prices reduce the quantity demanded. Conversely, demand rises as the product becomes more affordable. So, the law of supply. The law of supply relates price changes for a product with the quantity supplied. In contrast with the law of demand, the law of supply relationship is directed, not inverse. The higher the price, the higher the quantity supplied. Lower prices mean reduced supply, all else held equal. So, an important thing to remember, lower prices result in a cost squeeze that curbs supply. So why is this important? The law of supply and demand is essential because it helps investors, entrepreneurs, and economists understand and predict market conditions. So important takeaways for this video. Supply is resistance, demand is support. So in this infographic, we have supply zone. So how would we draw a supply zone is an area where price tends to resist and not want to break above. As we can see here. And a demand zone would be a zone where people are wanting to buy many times over. So we can see here price jumped, price jumped, price jumped. So that we would consider that a demand zone. So what time frames should you be using for supply and demand? So you may be able to find supply and demand zones on any time frames. And as we've learned in our time frame analysis video, usually trading on higher time frames will result in a more accurate trade and accurate decision. But as we can see, more trades on a lower time frame because you're going to have more candles in a less amount of time, less trades on higher time frames. So to put this into perspective, we're going to go take a look at a chart. So looking at DXY, we will actually take this away and we're going to draw out what we think some supply and demand zones will be. So we can go ahead and draw this zone out. So we see price reacted pretty heavily here and bounced pretty well. Pretty strong reaction. So for your demand zones, you're going to be wanting to look for areas where price jumped pretty heavily. So as we can see here, we can maybe use this as a zone. And we have right here, we have a zone where it actually resisted again, but it also became a support area. So sometimes when you're trading these zones, they can actually turn from resistance, as we can see here, to a support level. So when you're going through, you just want to analyze areas where price likes to react at. So here we can see two times that price like to jump out of this area. So we can go ahead and draw that as a zone. So just with these three zones, we're going to go ahead and play this and see how price reacts at our levels that we just drew out. So we can see price coming into that zone right now. Broke straight through the zone. Now we touched this zone and price kind of strayed away. We had a bit of a double top here. Coming back into this zone. Price touched this zone again. As we can see, we had about a 1% move out of that zone. But now it is coming back in to this zone. You can see here it kind of supported, resisted, playing around that level or that zone. Coming into this zone. So, just from drawing these zones out, without knowing what the chart looked like before when we replayed it. So as we can see, we just drew out these zones because we noticed price liked to react at these levels. And there would have been some trade opportunities. Maybe you would have taken a look here and been like, okay, so we have a strong red candle coming down. And maybe on this day you would have took a short because you're like, well, it's not liking this zone, so it's looking weak, so we would take a short. Here we can see it came into this zone a couple times and would bounce back up, testing the zone. Here we could have had maybe another short opportunity. If we know the market is weak and it's testing the zone, we can, put a trade maybe like this in this situation. Maybe we would have sold there, have a stop loss, of course. And had maybe a trade like that, something like this. So analyzing this, would have said, okay, market is looking weak. So let's see, go back one bar. Would have said, okay, we're going into a downtrend. Market's looking weak. We're coming into this zone again. So we would think, okay, we're going to take a short here. Short here. Stop loss in place. And we would take profit into our next zone. Like so. We would have sold around there or bought back since we're shorting. And as we can see now, price is trying to actually bounce back out of that zone here in February, early February. So That's just a basic video on drawing supply and demand zones. Um, that's just for this series. It's a pretty basic understanding of the relationship between buyers and sellers and supply and demand zones. And you can use these to trade and kind of predict levels and where price might react. And it's definitely a good skill to learn. Thank you for watching, and I'll see you guys in the next video.